Yeah, good afternoon, dear listeners, and thank you very much for your participation in this monthly webinar. So let's kickstart our webinar. We'll start with the portfolio performance across our schemes. So if you look at Coffee Can, it's been a good month for us, wherein we've generated almost 100 basis point alpha. Resultantly, if you look at the 1 year performance, we are now back in terms of alpha as well. So led by a very good improvement in the last couple of months. The top performers in Coffee Can were Ashok Leland, Ultratech, ABB India. The key draggers were Indigo, Kotak, and Bharti Airtel. Moving on to Good and Clean. So if you look at Good and Clean, which is our mid-cap portfolio, it has made a phenomenal comeback in the last 6 months. If you look at 1 month, 3 month, as well as 6 month return, there has been a significant alpha generation in terms of strategy. The key performers as far as the last 1 month is concerned were Hindustan Copper, MCX, Bharat Electronics. The key draggers were PTM, which is 197 Communication, Trent, and Phoenix Mills. Moving on to micro marvels. So if you look at micro marvels for the month of January, it's been in line with the small cap index. However, we would urge you not to compare micro cap in general with small cap, because the nature of micro cap is very different in terms of market cap. So it's more absolute 5 year strategy, and if you look at incrementally from here on, both for small cap and micro cap, things are turning at the margin. In terms of top performers for the month were Entero, Menon Bearings, and Cantabile. And the key draggers were Landmark, Mac Power, and Insecticides India. Moving on to pricing prowess, which is our AIF scheme. The 1 month the 1 month return was more or less in line with the benchmark at closer to about -3%. In terms of the top performers were MCX, Ashok Leland, and Solar Industries. And the key draggers were Mediassist, Maruti Suzuki, and Foseco India. Moving on to the topic of the month, which is the illusion of stability. So herein we are sort of talking about the India's consumption sector, and why we believe that over the course of next 1 year, there should be a significant comeback in this particular sector. So in this slide, if you look at a slightly long-term period of the last, say, couple of decades, generally in consumption, what we like is that typically the volume CAGR generally tends to be far superior as compared to the price CAGR. So if you look at the table on the right hand side, phase one, phase two, as well as phase three. What was good for the consumption sector was that the revenue growth was primarily led by the volume growth. So India in general is a more volume driven economy as far as growth is concerned. Yes, there is a case for premiumization, but the target audience to play premiumization is far, far lower compared to the mass population. So therefore, I mean, if you look at phase one, phase two, and phase three, which is up until FY20, the sector was very much in flavor because the volume growth continued to dominate the revenue growth, meaning that the revenue growth was more led by volume rather than price. However, what happened post-COVID, which is during FY20 to 24, was that the sector started seeing a lot of price hikes. The reason for the price hikes has been primarily inflation in the key raw materials. And as a result, you can see that the revenue growth was primarily price led and not volume led. Now, when that happens, obviously the sector starts getting a bit derated, because whenever the price increase is led by sort of raw material inflation, then in general people are not very comfortable, because subsequently comes a phase where the raw material prices start to decelerate, and resultantly the price also starts declining. So to that extent, the revenue growth starts getting tapered. As a result, what happened was that during FY20 to 24, the sector actually went through some derating. But essentially, as we get into more slides, we'll discuss that how this trajectory is now changing back to the earlier phase, where the sector will start seeing a very strong volume growth. Next. Yeah. So here also you can clearly see the pattern. So if you look at the top three charts, you can see that the light pink bit of the chart is dominating the buildings, meaning the if you look at the first three columns, you can see that the domination is by the light pink color. But if you look at the last column, you can see that it's equally split between dark and light pink. Now, what is light pink? Light pink essentially is a volume growth. And if you look at the dark pink side, it's basically the realization growth. Now, as I told you earlier, that in the first three phases, the revenue growth was primarily led by volume growth, which obviously is a liking as far as investors in this sector is concerned. But obviously, in the last phase, which is 20 to 25, it was the revenue growth was equally split between price and volume, which generally people don't like in a country like India, which is very, very price sensitive and more mass driven. So it's basically a reiteration in a far more legible manner of what we were discussing earlier. Moving on. So what companies did in the last 4 years? So last 4 years have been very challenging for the consumption sector in general, because of the significant inflation which happened on the raw material prices. So what did companies start doing? They started focusing more on premiumization, because they said that typically if we do not focus on premiumization, then the unorganized players will start gaining a lot of market share. Because generally in a inflationary environment, what tends to happen is people start doing down trading, meaning that they will start shifting to unorganized brands, because of the significant price difference which is there between organized and unorganized. So obviously, to ensure that the revenue growth momentum continues, the branded companies started focusing on premiumization. So you can see on the top left hand side of the chart that especially in detergents kind of a space, companies started pitching more of liquid detergents rather than sort of powder detergents, to ensure that they sort of focus more on premiumization, and accordingly focus more on revenue growth. Also, they started experimenting with alternative channels like e-commerce, which now contributes to a fairly sizable percentage of revenue versus what it was earlier. But clearly, these kind of strategies in a country like India are not very sort of sustainable, meaning that in India you need a volume growth, whilst premiumization can be sort of a lever of growth, but it cannot be the only lever of growth. So therefore, for investors to sort of look at this sector, it's very important that the volume growth for the sector starts to make a bounce back. And in the slides going forward, we'll tell you why we are believing that volume growth will really make a comeback. So the first driver obviously is the rural demand, which we are seeing significant signs that the rural demand is likely to make a comeback. So on the top left-hand side of the chart, you can see that after a very long time, the real wage growth is in a positive trajectory. If you look at previous sort of periods, the real wage growth had actually become negative. Now, that's obviously a big concern because if the real wage growth in the rural areas is negative, then obviously there is no savings per se because actually your inflation eats away your savings. So when the real wage growth turns positive, it actually means that on the net of inflation basis, you are actually increasing your savings. So that is the first positive. Second, if you look at MSP, which is the minimum support price announced by the government across major crops, has been consistently rising, and even in the last period, we have seen a mid-single digit kind of an increase. So that again actually acts very favorably. Third, monsoons obviously have been very favorable for the second time in a row. We have had monsoons which are far better than the long-term average. So obviously that also helps in terms of rural demand picking up. And most importantly, after a very long time, we are seeing CPI inflation sort of coming off in a significant manner. So if you look at the current CPI inflation, it's almost at a 28-year low. So clearly, a real wage becoming positive, MSP hikes, above average monsoon, record low inflation is a great recipe as far as pickup in rural demand is concerned. Moving on. Alongside that, government is also acting as a very big facilitator. Recently, we saw a significant cut in terms of GST across several sort of categories, which includes obviously automobiles, footwear, apparel, etc., etc. Secondly, if you look at pay commission hikes, we expect almost a 34% increase in terms of government wages under the next pay commission, which is likely to get announced maybe in the second half of this financial year. Also, states are acting more and more socialist in an effort to win elections. So obviously, across a lot of state elections, we have seen a horde of populist schemes getting announced. So to that extent, government is also doing every bit possible to sort of drive consumption in a materially larger manner. So herein, obviously in terms of if we have to summarize the last two slides, what we are trying to highlight is that both across rural sector, we are seeing a significant comeback, and also the government is sort of facilitating that comeback in a very smart way. And resultantly, what is happening is that you'll see initial signs of volume growth also picking up, and obviously we'll get into that discussion sort of in the next two slides. But here, what we are trying to present a case study is that within the consumption space, if you're looking at sort of two good sectors to sort of look at in terms of investments, then jewelry and apparel clearly seem to be two good sectors which have actually shown significant improvement in terms of execution. So herein, what do we mean by significant improvement in execution? You can see that the share of unorganized across jewelry and apparel has been historically very, very high. But obviously, over the course of last 10 years, there has been a significant improvement in terms of organized player taking up market share across both jewelry as well as apparel. There are several case studies in terms of organized players who have been doing phenomenally well in both the sectors. Obviously, herein we don't discuss those names, but everybody knows how the jewelry sector has done as far as stock price as well as fundamental performance is concerned. So these are the two sectors which generally should do well as far as someone looking to play consumption is concerned. Now, moving on. So, coming back to the earlier sort of thesis of the newsletter, that we are seeing volume growth come back. So, if you look at within the overall consumption space, if we are looking at volume growth coming back, is it reflective in the numbers as well? So, if you look at revenue CAGR for the period FY25 to 28, you can see that across various pockets of the consumption space and across various companies, Britannia, Colgate, Dabur, Imami, etc., in FY25 to 28, you are seeing a much higher revenue growth estimate compared to the earlier periods of FY19 to 25 or FY15 to 25. And likewise, you are seeing accelerated EBITDA CAGR as well as PAT CAGR over the next 2 years across several of these companies. So we believe that at least for the next 12 months, the consumption sector led by staples, and obviously you can see several of the names which are listed here, are likely to do well. And the reason why this time around these companies will also get valuation re-rating is because this time around the revenue growth will be more led by volume growth and not price growth, because as we discussed earlier as well, that CPI inflation is also at 28-year low. So to that extent, we believe that a lot of categories will not see price increases. So therefore, a volume-led strategy generally is more sustainable in nature. So to that extent, there is good visibility of revenue growth over the course of next 2 years. In fact, if we look at several ad spend budgets of consumer companies, we are seeing a significant increase over there as well. Whatever savings they are seeing in terms of gross margins are getting deployed into ad spends, and the reason for that is that all of these companies are now targeting a virtually high single digit or low double digit growth. And as these volume growth numbers start getting reported, we believe that this sector should see a significant re-rating, as was the case 5 years back. So, just to sort of conclude, we continue to remain overweight on the consumption space. Obviously, within the consumption space, we like both staples as well as discretionary. And clearly, we believe that it makes sense for sort of to go over board on this particular sector, given the kind of tailwinds which we discussed in terms of rural demand seeing a pickup, government acting as a facilitator, and inflation being at sort of all-time low. So to that extent, we believe that the sector is up for significant re-rating. I think that's what we wanted to share as far as the newsletter is concerned. Now we open up the floor for Q&A.